Polytetrafluoroethylene. It's a chemical used to coat a variety of products. It's waterproof, it reduces friction, it creates a non-stick surface. Now, commercially, it's known as Teflon. And for weeks now, it appears that the stock market has been coated with the stuff. But what happens when the Teflon starts to wear down? Now, certainly beneath the surface, things have been pretty ugly for this market. Even yesterday, the major indices made impressive moves off the intraday low, and they closed with extraordinarily weak internals, especially stocks trading on the NASDAQ composite. In fact, coming into the session, only 48% of the names on NASDAQ are even trading above their 200-day moving average versus 84% for the S&P 500. Now, according to the EPA, Teflon becomes unsafe above 500 degrees and turns into a carcinogenic over a period of time. Is it time to start worrying about that happening with the market as the veneer rubs off to reveal weakness that's been in place already for some time? Joining me to discuss, Strategic Wealth Partners Mark Tepper, Bell Point's David Nelson, and Veritas Financial's Greg Branch. Mark, let me start with you. Another tidal wave of missed economic data this morning. Negative reactions to earnings. Some were okay. Obviously, the market grappling for a catalyst to remain higher. What are the answers that investors are looking for?
Charles, I think that probably the three big things investors want to see right now is that, number one, that Delta concerns obviously need to fade. Number two, inflation needs to moderate a little bit. Number three, supply chains need to normalize. But Charles, if you think about it, I mean, the market's up 100% from its bottom. We're actually up about 33% from the pre-COVID levels in a year and a half. So we've actually gotten 3 years of returns in about a year and a half, all while we're still stuck in the middle of this 100-year flood. So my question is this: have we become a little bit spoiled as investors? Are our expectations too high? Because the market doesn't go up 15 to 20% year after year after year. So I think we all just need to have reasonable expectations and understand that a lot of the easy money's been made.
All right, and by the way, I'll answer your question. It's hell and yes, we have become spoiled. David, in the meantime, you've been talking about and pointing out the fact that there have been rolling pullbacks. There have even been rolling corrections. But what about the overall index, right? The overall S&P. Is it time for a 5% or better drawdown?
You know, we haven't even we had barely a 4% drawdown in the S&P 500, but we know as market observers underneath the surface, it's been a lot more chaotic. But to your point, we have had a rolling correction. You know, virtually almost every asset class or sector in some way, of shape or form has pulled back. More than 7 sectors that had more than a 9% drawdown, energy 15%, even technology has pulled back 9%. So it begs the question, you know, did it really pay to have all this trading going on, running from growth to value and back again? It really didn't pan out. In the end, if you just sat in the middle of the boat in the S&P 500, you got the same return. I would ignore a lot of the noise here. There'll be a pullback at some point. Use it as an opportunity.
Greg, you've been strong and doing extraordinarily well with your value plays. Are you staying the course there?
No, my course has tempered. You know, we're not looking at the same breadth of value opportunities that we were 8 or 9 months ago. Financials are no longer trading at price to tangible book or beneath that. And so we've seen a lot of the valuation ground made up. And now some of these sectors are merely plays on earnings growth. And when we have a situation like this, where the market is searching for a signal, and we as investors are searching for a signal, you're better off looking for the stories you like, stories with secular tailwinds, stories with structural advantages, rather than playing a theme. And so I would say that there are stories I like in growth and stories that I like in value at this point, while we wait for the Fed to make up its mind about what it wants to do.
You know, speaking of the Fed, Jerome Powell started speaking about 35 minutes ago. It feels like he might have said something. I'm not privy to everything he's saying. And I know he did address Delta a little bit here, but we're certainly trying to come off the lows to get back to that point now. Someone mentioned that the S&P doubled. Really the fastest time it's ever gone up 100% since World War II. It hit its 49th all-time high yesterday, 322 since 2013. Here's the thing. It only made 9 new highs from 2001 to 2012. So looks like we're dealing with these decade-long periods of boom and bust. So with that in mind, Mark, how much longer for this one? I mean, could it conceivably go on much longer?
I actually think it will. And look, Charles, normally whenever someone says this time is different, you end up looking like a fool. But I'm going to say it anyways. So you've got the Fed, you got the Treasury. They have eliminated your traditional business cycles of economic expansion followed by a recession. because they've been very quick to act ever since the great financial crisis. Quick to cut rates to zero, quick to drop trillions of dollars in people's laps. So any of the dips in the market, while the drawdown was very substantial last year, they're quick, right? The market recovers very quickly. Personally, I think we're still in the early innings of a secular bull market. I don't think it ends until interest rates go to a level that'll choke off economic growth, maybe 3 to 5%.
Greg, you keep hearing in the financial media, particularly this week in the Wall Street Journal and other places, that the Fed is ready. They're on the cusp. It's going to happen. They're going to announce they're going to start taking away the punch bowl sooner rather than later. And then I look at the bond yields, and it keeps telling me something else. What's the deal here? I mean, what are you doing with respect to a possible tapering, and have you come up with a timeline?
Yeah, I'm probably one of those people in the media that you mentioned, Charles. And the Fed certainly hasn't been quick to the draw on changing posture here. Look, at the end of the day, it is very difficult to argue that the labor market needs further nursing to health. The jobless claim numbers the last couple of weeks has shown no deterioration due to Delta yet, admittingly, but we've seen pandemic low numbers there. We dipped down to 5.4% unemployment. We still have 10 million jobs on offer and only 9.2 million people underemployed or looking for employment. So if the Fed's justification for continued easy monetary policy is we need to have care over the labor market, that argument seems pretty pointless at this point. And so maybe they'll adopt a new argument in terms of the consumer confidence number that we saw from University of Michigan hitting a historic low and the retail sales last month. But they got to go somewhere else.
Although there are still something like 7 million fewer people working now than last February, David, here's the thing with this taper tangent. We talk about it a lot, and I'm a little bit of a contrarian. I mean, I don't think we're going to have anything near the worry we're talking about, the 2013, and I'm ready to be an aggressive buyer if we do get a tantrum. How would you handle it?
Look, to me, the question isn't, whether or not you buy on a dip like that. The question is what you buy. And to Mark's point, and even Greg's point, you're going to have to be selective. Look out there for really what you want to own. Interest rates are going to have to go significantly higher for them to be a competitive asset class. And I think it's going to be difficult to even get above 2%, especially when you look around the world. Germany, completely underwater, negative rates.
Right.
In Japan, very low rates out there. So it's going to take a major move in interest rates to be competitive because everything starts with the risk-free rate. U.S. stocks are still the better asset class regardless.
Right. And real rates, by the way, are down. Guys, I got a minute to go. You've all kind of teased all these wonderful places where we can make money. Can we narrow it down a little bit? Maybe share what you're looking at. What might be your favorite idea, starting with you, Mark?
Yeah, so I like Blackstone. I think it's a good place to hide out right now. The financials are looking really strong again from a momentum perspective. And as an investor, as David mentioned, bonds aren't very exciting. Nobody really wants to own bonds right now, but people still want to diversify away from stocks. So Blackstone's the biggest private manager out there. I like that.
Greg?
On the value side, I'm looking at the casinos. Recall I was bullish on them a year ago. They ran up into April. We're now back down to valuation levels, what we saw, big tech like Google, 30% operating margins, 20% growth at a market multiple on 22. Yes, please.
So we'll roll the dice with the casinos and look at a couple of techs. And real quick, Dave Nelson.
Sure, I think healthcare is a great place to weather out this storm. You could get it to a name like HCA, less than a market multiple. And if you're looking for a growth stock, look at Thermo Fisher. TMO, one of the great growth stocks, 26 times forward earnings.
Absolutely phenomenal. Yeah. One of the best companies ever. They just made a major acquisition. And in healthcare, the last to go red today. You might be onto something. You guys are fantastic. Mark, David, Greg, thank you all very much. Meanwhile, folks,